Good afternoon, ladies and gentlemen. Today we're going to cover the A2 Milk Company, and I'm going to briefly cover the fundamentals and the technicals behind this stock and what's causing the drive down, along with potential buy targets in the near future. Now, real briefly, before I get onto that, I just want to say I'm not a financial advisor, so do not take this video as financial advice. Nor am I recommending you to buy, sell, or do anything with this stock or company. Simply take this for educational and entertainment purposes only. Now let's take a look at the technicals. We initially had in Discord a target of $8, and that was all the way until November 2021, roughly. So that was a 1-year target to bring it down to $8. And what we have is it came down to that target within 5 months. So fundamentally, it was just a failure. So I'll bring up the daily chart. And we can see here on the 23rd of November was when this stock broke through a major level, came back up and failed again. And that's where our discussions began at around $14. And we can see this trend line if I zoom out, the significance of it. So $8 was the target. So let me talk through the target. We have a Fibonacci level here. If I zoom out further, we have 61.8, which is $7.90, but close enough to $8 to be a significant level. It's a nice little horizontal here as well. But most importantly is the pivot point here where it began the next major swing to the upside. So we've got some really, really strong technical targets here. You can see 50% held on even after a massive gap down. It held. Fundamentals came out. I believe that was a downgrade that day. Came down. Even the 61.8 really barely held this stock up. It moved like 50 cents from $8. It was terrible. So from a technical perspective, it's just on a monstrous downtrend. So let me just draw this channel here. You can just see how terrible this is. It's a significant level, and then breaking down from a descending wedge or a descending triangle like this below is super hyper bearish. I can't explain enough how bad that really looks from a technical perspective. So we have exhaustion, volume exhaustion every time it gaps down, every single time. And we can see the volumes are increasing as the price is dropping. It's been a lovely intraday short every single day in A2 Milk. It's been no-brainer shorts. So at the moment, what we can see is potentially volume exhaustion coming through and a swing to the upside. But really breaking this trend line will be key for any kind of reversal. Until that's broken from a technical perspective, it doesn't look crash hot. However, we can look at this stock from a fundamental perspective and have a look at a price target based on how the company's performing. So there are two different targets. One is technicals and the other one is fundamentals. So from a technical point of view, if one was to strictly look at this from a technical view, from just the charts, there is absolutely no buy entry in sight. It really does come down to confirmation of breaking this level and possibly coming back to retest either this horizontal or retesting this trend line, this major trend line. And you might be wondering, well, that's not buying the bottom. You know, that's from $5 down to like $6.90. Why would I want to buy it at $6.90 when I can buy it at $5.20? Well, the answer there is you're bottom picking, and that's gambling. That's ultimately what that is. So if we take a look at this stock, every time it dipped, $10, that looked cheap. $8.88, that looked cheap. How about $7? Well, now it's $5. So how often can you say, oh, it looks cheap before you get mauled? Now, when this stock, or if this stock hits $5 and you buy it $5, which I don't think is awful from a fundamental perspective, but purely from a technical view, if you buy it $5 and it drops down to $4, you've lost over 20%. You've just straight off the bat, you've lost 20%. Why? Because you're trying to pick the bottom. And for all you know, there's going to be another downgrade. It comes and it smashes the share price. So no, bottom picking is not in my repertoire, and it shouldn't be in anyone's repertoire of investing and trading. It's gambling and it's terrible. There is no risk management there. It's just pure stupidity. Now, I'm not trying to rail too hard on people who do it because I know you don't know any better. But really, from a technical perspective, again, there is absolutely nothing in sight. But there might be something fundamentally. So let's take a look. What we have here is the annual revenue, Ebitda, and net debt. As you can see, it's been performing and performing consistently. We can see an uptrend basically in every metric. Net debt rising is not that big a deal as long as revenues are going up, because eventually Ebitda will also go up. Your net debt will naturally come lower and lower as you spend less on advertising and perhaps building facilities and warehouses and the like. As long as revenue is maintained, net debt increasing is not that big of a deal. The big deal we're seeing is the forecast downgrades. We're now looking at revenues significantly in decline, and we might be comparative to the financial year of 2019. And you might look at this, that's calendar year 2019. You might be looking at this and going, well, shouldn't the share price, because these numbers are pretty similar, June 30th, 2019 and the upcoming June 30th of 2021, should this not be the same? So let's look at 2019. June 2019 was around $16. So you might be wondering, well, isn't this heavily undervalued because it's now $5, even though the numbers are similar? Well, in context, a stock will rise and keep rising in anticipation of future performance. So here, that's not what the company's worth on that day. That factors in and prices in continuous growth of the company in terms of revenue, in terms of transactions, in terms of customer numbers, more DIGOs coming through, potentially reductions in debt. All these factors come together, and it's baked into the existing share price at the time. Because on this trend, one would possibly expect maybe a 40% increase in revenue. That 1.7 could look more like maybe $2.1 billion in revenue. Ebitda could look more like $800 million. Net debt might be in reduction, right? So you factor all that in and you can see why the stock is rising. Now what's happening is we have our first real taste of financial downgrades, right? We've gone from 1.7 to 1.2. So the panic and concern now, especially because it's downgrade after downgrade after downgrade, firstly, the concern is there going to be a fourth downgrade? And the second concern is, what about the financial year following that? Are we going to go from 1.7 to 1.2 to 0.8? Are we going to be $800 million in revenue? Right? That's the idea, is that the share price is baked into future performance. So is the company worth $5 now? Probably not. But it might be worth something like $8, but it's factoring in that future profits, future revenues are not going to be rising. They're going to be in decline. So people are selling in anticipation that it's going to go lower. So here's a reflection of this. This is a nice graph. I think it reflects exactly what's happened. So it's not uncommon to have a total enterprise value divided by revenues in high multiples, right? I'm not going to go through earnings per share and all this generic stuff, but I think this is a real good representation of the relevance of the enterprise value of the company and dividing it by the actual revenues. This gives you a nice visual representation in relation to its market capitalization. You can see what happens every single time. It rises and rises, and people are happy to pay up because they're seeing the performance of the stock. And then it hits a certain multiple where it's like, hold on, maybe we've paid a little bit too much. And you can see from a market cap perspective, it consolidates. Right? We're sitting at 10 billion market cap. We're going sideways, 8 billion, 9 billion. And the multiples are going down. So a more realistic level. And then what we have is a phase of exuberance, where the market cap is rising, but the enterprise value isn't rising as much with it. There's a bit of exuberance there. And now what we have is the multiples crashing down. People are selling off. We now have an enterprise value over the revenues of 2x. We're now sitting at a market cap of around $4 billion from a high of about $15.5 billion. So here are some structural concerns ever since August in 2020. The inventory levels are simply too high and they're rising. not only is there going to be wastage and spoilage, that brings down margins, margins drop, you've got wastage, there's probably extra costs in terms of storage for the inventory as well, because and do keep in mind it does spoil. And there's no students coming in, there's no international travelers coming in to be the Daigos that take the product and sell it. All right, there's a lot of structural issues, and there's a lot of reliance on the Daigos as well for the performance of the company. But as you can see, as the sell-off is occurring, the multiple is coming lower and lower and lower to the point where it's cheap. Kind of like earnings per share is sort of a measure of how cheap a stock potentially is. But keep in mind, just because this number is dropping, it's dropping for a reason. It's not just cheap because it's cheap. It's not just like it magically drifted off, people forgot about it, and hey, you've got some value. No, there are structural issues pulling this stock down. And I just described what some of those structural issues are. And really, it stems from the fact that the financial forecasts are just dropping. I mean, it's dropped about, I think from memory, almost 30% for the financial year. And there's just been so many price drops in terms of the revenue targets for the year that there's just little confidence in it now. Even if they don't bring out a fourth downgrade, what's going to happen next year? That's probably what's on the mind of holders at the moment. So I do want to point out that there are some upsides to the stock. There are three that come to mind. Firstly, A2 Milk is not an Australian company. It's a New Zealand company. So whatever issues there are in terms of trade wars between Australia and China may not flow into New Zealand. In fact, I personally don't know what the situation or relationship between New Zealand and China is, but I'm almost certain it's far better than Australia's current relationship. The second one is that A2 Milk does have an import license available to it to import into China. Now, there is sovereign risk there because China typically isn't a country that cares too much about law and order. Whenever it comes to its own convenience, it may just decide that that import license doesn't matter and cause some havoc. But really, I don't see that happening at the moment, but that is something worth noting. And the third one is that the borders will eventually open back up. People are buying Qantas, Flight Centre, Webjet in anticipation that flights are going to return. Well, in the same respect, one might expect A2 Milk to return back to normality sometime in the future. Now, we know this business model works. We know it works. We know because from 2017 to 2020, it was on a monstrous rise in terms of revenues, in terms of EBIT growth, in terms of sales growth. Every metric looked healthy. And now what we're seeing is a turnaround. And do ignore this 2022 number. I don't agree with it whatsoever. But there is the first turnaround, and the question is, can these revenues recover? In 2022, can it recover? And can it return to some kind of normal where the trajectory is swinging back to the upside? So from a fundamental perspective, in terms of market cap value and its association between enterprise value and revenues being relatively cheap, relatively, and I do emphasize relatively. For its current situation at around $5, it begins to look cheap fundamentally. But one must consider that that entirely relies on the company's management being able to turn this company around and swing it back to what it was doing best pre-COVID. Now, I don't know if the company has that ability to do so, but I do expect that in 2022, things will head back more towards normal in terms of trade, in terms of flights, especially with the vaccine rollouts and such. Now, I don't know what 2022 will look like in Australia, whether we will let other travelers in or if we just let the Australians who vaccinate in the country. That's yet to be known. So there is a huge risk in investing in A2 Milk. This used to be a AAA company, absolutely. The best of the best in terms of growth, in terms of potential to become a nice large cap company. So technically, are there targets yet? No. fundamentally, there is still high risk. But if I was to look at buying this stock, and I do intend in the future to look for opportunities, I would factor in that a takeover may be really tempting. For a company like maybe a Chinese company, maybe Nestle might find some interest in this company. I think when it starts hitting this kind of sub $4 billion range, anywhere between 1 to 4 billion, anything sub 4 billion really, I think is an attractive and appealing takeover offer, because one can look at the history of the company and see its potential based on what it was doing best back in the day. And maybe it just requires a better company to take it over and continue that trajectory of profitability and growth. That's my expectation. Now, I wouldn't personally buy because I would expect a takeover. I would look at a reversal from a fundamental perspective. I want to see growth come back into the stock. Anything below $5 would start to look attractive from a fundamental perspective on the anticipation that revenues will come back in 2022. That's all that is. I think there's an exuberance of selling, and that it has pushed it from a fundamental perspective. I think it has pushed it into levels of affordability for a takeover. We're looking at still over $1 billion in revenue, right? I think 1.4 was the latest target. And as a, that's what, 3.5x revenue is the market cap. That sounds extremely appealing to me. That sounds really, really appealing. So do keep that in mind. Fundamentally, it's starting to get, I believe, in that range of cheap. Now, if I was to buy it, if this continued to sell off, if there was another downgrade, that'd be really unfortunate. But I would consider how much that downgrade is. But anything under 5, my own personal investment strategy and target for this would not be to go all in at once. It would be to partition my entry should I consider getting in. And anything under $5, I would consider getting in. I really would. I think the potential's there for both the takeover and or for the reversal in terms of revenues and growth. I really think it's there. So for me, I would look at maybe 15% of my entire total position at around $4.90. And then scale in as it drops to $4.20. If that happens. If it doesn't, great, I can build my position on the way back up. I'm not too keen, I'm not too interested in bottom picking, but I would be interested in scaling into the position based on the reality, the trading reality, that I'm not going to be successful at picking the bottom, because no one is. Picking the tops and bottoms is a fantasy play. So scaling into the position as it goes down would make sense for me. And I really wouldn't want to see it go below maybe $4. $3.80 at the absolute worst. And then there'd have to be a stop loss there somewhere. And really, it would have to be a serious fundamental tragedy for it to go below $3, $3.50, I think. So that's my opinions on the stock. That's my strategy for considering investing, is 15% chunks at a time as the price drops, provided the fundamentals don't change, as in we don't get another downgrade and things get even worse. So as long as the fundamentals stay steady, I would like to see this stock below $5. I think that'd be a good scale-in opportunity. Tell me what you guys think in the comment section below. I'd appreciate that very much. Otherwise, guys, have a good night.